the mini trying to test yesterday's sell climax high, and then especially Thursday's sell climax high. The bulls want to break above the sell climax high and a measured move up. The bears want to break below and a measured move down. The bears had a 3-day head and shoulder stop, left shoulder ahead, right shoulder, nested within a 2-week head and shoulder stop. "15-minute chart, left shoulder ahead, right shoulder," but they're breaking above the head of the right shoulder, which is the right shoulder of the larger pattern. So most head and shoulders tops do not lead to reversals. Most of the time they lead to either sideways or up. Today's the first day of August, and I'm going to change this to the low of last month up here. Change that blue line. Okay, it's okay. That's the July low. The green line's okay. Higher lows and trying to get higher highs, and then trying to get above here. Most days for the past couple of months have had a lot of trading range price action. You can see on the daily chart, sideways for a couple of months, a month, and this might be the start of another month-long trading range. And when the market's sideways like this, a lot of the bars have prominent tails, which means the market went one way and then it went the other way. And that's been the case here. A lot of trading range trading, either the day has been very small and sideways, or it had a big move one way and then reversed. Most of the reversals have been up, so the market sells off and then reverses up. A lot of the bars have tails below. One of these days we'll get a big sell-off, and it will not reverse up, and it will not reverse up the next day. We'll start to get consecutive big trend days, and when that happens, then we've probably begun the move down to support. This is a spike and channel pattern on the daily chart, so spike, pullback, channel, and we've had 4 pushes up, 1, 2, 3, 4, or if you want, you can call this the first. And the spike and channel pattern, in market cycle, you get a breakout, you get a channel, you get a trading range. The odds are that this channel is going to evolve in a trading range and that the market will test major higher lows here, here, and here. Usually it tests down near the bottom of the channel, which means somewhere down here. We may get one more push up, but probably not a lot more up. Weekly chart, incredibly overbought, 37 weeks without touching the moving average and without even getting close. This is not all that close. And mathematically, it never has to touch the moving average. It can stay above the moving average forever. However, usually if it stays above it for 10 or 15 weeks, it gets down to it. This is really, really unusual, and the E-mini has never done this before in 17 years. So unlikely that we're going to continue much higher without pulling back to the moving average. Monthly chart, last month was a bigger month, but it's a 7-year bull trend, very strong over the past year, and now we have a 9-month bull microchannel, 9 months where every low is at or above the low of the prior bar. That is extreme strength occurring late in a trend, and that usually is a climactic move. No sign of a top yet. This rally went on for a couple years, for several years. This could as well. Not likely. So far, another early sell-off. A lot of days over the past month had early sell-offs here, a little bit here, and then more here, here. here. So today's no different. Big tail on the bottom of one, even though for the bears it's a double top, yesterday's high. That big tail on the bottom of the bar means that there was some buying going into the close of the bar. That will make traders hesitant to sell below the low of one. A lot of traders will sell on the close of one. If it closes below the midpoint, they'll immediately sell at the market or with a limit order looking for a scalp. And it has to fall 5 ticks from that one close to make money, okay, which it just did. A lot of traders will not sell down here because we're right above the moving average, both the 60-minute and the 5-minute moving average. Buyers buying the one low and 1 point lower, or simply buying 1 point lower. You can see it went 4 ticks below the one low and bounced because there were buy limit orders there. You can call it an expanding triangle top, high, higher, higher, and then low, lower. But the pattern is small and the sell signal bar 1 is not good. It's too big relative to the pattern. So selling below 1, you're selling in the middle third of the triangle, which is too low down. Bulls want an opening reversal up from the moving average. '60-minute chart, still head and shoulders top, left shoulder, head, right shoulder. And now we have a double top here. Weak rally. A lot of times when you get a sell climax, you'll get an endless pullback, a channel up, and it just keeps going up and up and up. So it looks like a bull leg in a trading range or a bear flag, yet it just keeps going up and up and up to above the climax. And that's what the bulls are hoping, and the bears obviously want the reversal down. Pretty neutral, right? Sideways for a couple of weeks. To buy above bar 2, I'm not sure that it's worth it. So I'm not sure that bar 2 can do anything that will make a lot of traders buy. Buy 1, pretty good sized bear bar, and a lot of trading range trading on the screen. Traders do not want to buy too high unless things look really good, and I think 1 makes it difficult for traders to buy above 2. When it bounces up and down quickly like that, usually a sign that the volume is pretty big. Globex chart, head and shoulders top, triggered the sell by going below the neckline, and instead of breaking strongly to the downside, we're bouncing. Consecutive bear bars, so always in short, but we do not have the context that we had yesterday. Yesterday we had a short below 1, and then a new high, and then a short below 3, so that was a second entry for a failed breakout above the prior day's high. Here we have a double top at the prior day's high, but fairly prominent tails in the bottom of 1 and 2, so it's a lower probability short. Also, you're selling in the middle of a trading range and at both the 5 and 60 minute moving averages. Bad location. More likely buyers around where we are. That does not mean we reverse up and form the low of the day. It just means that probably will go up at least a little bit. Consecutive bear bars, odds are sellers above the 3 high, sellers above the 2 high, sellers above the 1 high. The bulls are hoping that this is the low of the day, a reversal down to support the top of this trading range and both moving averages, but a lot of bulls will wait to see if we get 2 or 3 consecutive bull bars before buying. I'm looking for a particular pattern, and I don't have a saved copy of it. Here we're going to sell off, opening reversal, but a double bottom. Sell off, double bottom. I'm simply looking for an opening reversal where we get a sell climax down to the moving average and a reversal up. It does not look like I've saved any of those. All right, so for the bulls, opening reversal up from the moving average, but always in short, probably sellers above. Because it's maybe a 25% chance low of the day, it's reasonable to take the buy. But with those 2 bear bars, a lot of bulls would prefer to buy a small double bottom, or if it just goes straight up, they would wait to see if we get 3 or 4 consecutive bull bars and then buy closes. Right now, probably sellers above 3, sellers above 2, sellers above 1. Not a very good looking buy, and therefore the bulls are having a hard time getting it to go above 3 by going down a little bit. Let's say 4 is an inside bar, then it would be a II and a micro double bottom, opening reversal up from the moving average. That would be a higher probability buy than simply buying above 3. However, when you look at the chart and you say, wait a minute, there's some bear arguments. Oh, there's some bull arguments. You know, when things are confused, the market usually has to go sideways for an hour or 2. So this looks like the start of a trading range open. We have 2 bear bars, good for the bulls, good for the bears, but big tails 1 and 2, and then bull bar 3. So, you know, not strong selling, bad for the bears. We're in the middle of yesterday's range, and we're at both moving averages, which are magnets. And the result is there's no clear direction. The bulls and bears both have things in their favor. The result usually means that we'll be mostly sideways for the first hour or 2 while the market decides on the direction of the first swing. And it also increases the chances of a lot of trading range trading today, which means that we'll probably have at least 1 swing down and 1 swing up. looks like we're going to get an II. For the bulls, we gapped up, so it's a rally and a pullback. So this is a pullback from the move from yesterday's higher low here to the open. This is a pullback, a deep pullback, like this, same as this, a rally, and on the open, a deep sell-off, but basically a pullback. Same thing here, small version of it, from yesterday's higher low here to today's open, deep pullback. Here, deep pullback, deep pullback, from this low to the open, deep pullback. So today is similar to all of those. For the bears, a low one short. We have a reversal down and then a pause, and they're hoping that this is the start of a bear trend. But 3 sideways bars right above the moving average, tails 1 and 2. A lot of bears will not take that sell right at support. So too much risk of buyers below 4. We're at support, and we do not have a strong reversal down. We have tails 1 and 2, and then we have bad follow through for the bears on 3. It's a small bear flag in this early bear trend, but looks like more buyers than sellers below 4, which is expected. We're at support. Now the bulls have a micro double bottom, down on 2, up on 3, and then down on 5 and up on 5. That's a higher probability buy setup at the moving average for an opening reversal up from the moving average. But a lot of sideways trading. Of the first 5 bars, 4 are sideways, and 3 of them are very small. This reduces the chances of a trend day today, and it increases the chances that it's going to be another fairly quiet trading range today. We'll probably get a swing up and a swing down. The market now is deciding which will come first. Not a strong sell below 4, not a strong buy above 3. There's trying to get down to yesterday's close and then yesterday's low, but we have to get through the 60-minute moving average, and so far this is not looking all that strong. Normally, if you get a sell-off down to support and an opening reversal up, you have to get some kind of a double bottom or wedge bottom. So this would be a potential double bottom 2 and 5. So far, 5-bar bear microchannel, 6-bar bear microchannel, 6 bars where the high of every bar is at or below the high of the prior bar, so still always in short, but not a lot of traders willing to sell here. Here we are 3 minutes into this bar, and we have been unable to get below the low of the prior bar. Plus we overlapped the low of 4. We've had several wedge type reversals like yesterday, 1, 2, 3. And we've had several double bottoms lately. This is a type of a wedge opening reversal. This is similar to today, 2 legs down, 1 pullback 2, and the bulls got a bull body for the buy signal bar at the moving average. This was a 6-bar bear microchannel similar to today. But the bulls need a bull body on 7 to attract traders to buy above the 7 high. Five and 6 were important bars. They were opportunities for the bulls to reverse the market up, and if 6 is also a bear bar, especially closing near its low, then it increases the chances that we'll go lower. But we're right in the middle of yesterday's range. All 3 moving averages are within a couple ticks of one another, and they're flat. That means the market does not have much direction. That makes a lot of traders unwilling to sell this far down. Again, tail on the bottom of 6, always in short, but not bearish enough to convince a lot of traders that we're going a lot lower. So a lot of traders are not willing to sell here. Double bottom 2 and 6. II final flag 3 and 4, but bear bar 6. It's similar to the 2 legs down that we had last week over here, but there we had a bull bar for the buy signal bar. Even then, the market could not get back above the high of the day. So even if we rally for 8 bars like this, unless we get above the high of the day, it could simply be a test of the high of the day, like it was over here. 7 o'clock often has a report. What do the bulls have to do to take control? Well, they need big bull bars, preferably consecutive bull bars. They can do it with 3 or 4 small consecutive bull bars, like they did last week. Right, closing on high, probably going higher. But even with that rally, it could not get to a new high of the day. And then we collapsed. Unlikely to get that, but a similar open so far. So far, what we have today is similar to this: gap up, pull back to the moving average, and then trying to reverse up. Bear buy signal bar 6, 6 bars in a bear micro channel. Any reversal up can be the low of the day, but the bulls have to do a lot more right now. More likely sellers either at the 6 high or 1 or 2 points above the 6 high. A lot of bulls will wait to see if we start to get a series of bull bars and then buy. Limit order bulls who bought the too low were not, they were able to scale in. The bulls who bought the 4 low could scale in and made money. So the bulls buying below bars and a bear trend made money. That reduces the bearishness of this. Bulls trying to get that opening reversal up, but 6 bar bear micro channel, bear bar 6. A lot of the bulls will hesitate to buy up here. Suppose 8 closes on its high. Would that be enough to flip it too long? I don't know. I'd probably like to see if it's a big bar closing on its high, then it probably would be. again, it's trying to copy this 2 legs down to the moving average, and then always in long, 2 legs down to the moving average. I think that bear bar on 6 makes it a weaker buy than what we had last week with a similar type of pattern. Now for the bears, double top 3 and 8, 6-bar bear micro channel. More likely sellers somewhere above 6, maybe 1 point above, maybe 2 points above. Stop order bears. I think unless it's a really good looking bear bar, it's more of a limit order market. So I think a lot of bears will not sell below 8. If 8 is a big bear bar closing below the moving average, maybe bears will sell. Again, this is last week, similar type of open. Gap up, sell off for a couple bars, and then the second leg down. Gap up, sell off for a couple bars, a couple legs down. 6-bar bear micro channel, 6-bar bear micro channel, and then about 10 bars up. Bears trying for a double top 3 and a lower high. Probably sellers around here, around 1 point above the 6 high, but mostly scalpers. Three consecutive bull bars, closing above their midpoints, 2 closing around their highs. Is it always in long yet? I don't know. Whenever you get a reversal down like this, you got a 25% chance of it remaining the high of the day. And, even with the reversal up, I'd like to see more bars or a break above that high. Limit order bears who sold the 6 high and 1 point higher need 1 more tick to make a profit. Stop order bears for this double top 3 and 9. It's not a very good stop entry short. 3 consecutive bull bars. Why are we hesitating exactly right here? Because of what I said. You have bears who sold the 6 high and 1 point higher. Other bears who sold 1 point higher. Both need the market to drop 1 tick below the 6 high. They have limit orders to buy at the 6 high and has to fall 1 tick below. So you have a lot of bears trying to buy exactly at the 6 high. So there are a lot of buy limit orders from bears right there. And, bears trying to buy sometimes prevents the market from going down. Since it looks like a limit order market, I think the odds are we will drop 1 tick below the 6 high for the bears to make money. The bulls, they see 3 consecutive bull bars and they see this. They're buying the 10 low, betting that they'll make a scalp before the market drops below the 6 or 7 low. Most traders should just wait until we get a good buy or sell signal bar with good context, or a strong breakout up or down with good follow through. You look at it and it ticks down a couple ticks and you think bearish, and then it bounces back a couple ticks up and you think bullish. Right? Trading range open. Plus the range is small. The bars look like they're good size, but they're not. And it makes it difficult to make money. I did sell 1 point above 6, and I did not like that bounce on 11, and I got out. The math still favors the bears, but on a small trading range limit order market like this, I'm quick to get in and quick to get out. The bears who stuck with it just made their profit. It's not really a lower high major trend reversal because the market's sideways, so there's really nothing to reverse, but it is a lower high. You can see that we're not following Thursday's pattern. All right. Here we had a bull bar for the buy signal bar. Today we have a bear bar. And here we went up for 7 or 8 bars without a bear body. And here we went up for 3 bars. So this is less bullish than that. This is bar 11 near the close of the first hour. And for the bears, they have a head and shoulders top. Left shoulder, head, right shoulder on the 60-minute chart. They have a double top here. If you want, you can call it a wedge. 3 pushes up, 1, 2, 3, even though the third did not get above the second. Can you sell on a stop below 6? I would not. It's a trading range open. We're always in short. But, we're right at all 3 moving averages in the middle of yesterday's range. Bears trying to get a strong bear bar. Again, 60-minute chart, head and shoulders top. So 60-minute chart, lower high, major trend reversal. Bull trend, bear breakout to a lower high. For the bulls, if they get a bull bar, expanding triangle 2 and 6, tested yesterday's close. Yesterday's range was small, and that increases the chances that today could be an outside day. Even though it did not get above yesterday's high, if we go below yesterday's low, I would still consider that an outside day. Bulls again trying for an opening reversal. Will traders buy if it's a 1-tick bull body? Probably not. But if it's a 4-tick bull body, if it looks like 18, I think it would be a reasonable swing buy for a possible low of the day. But you need a pretty good bull bar to reverse a big bear bar like that. I talked about that yesterday on the 60-minute chart. Is this a strong enough reversal after a big bear bar like that? Usually that is not enough to reverse that, and usually the best the bulls get is a bounce and then sideways. And the same is true here. The bulls need a very strong bull bar to reverse that big bear bar. Otherwise, a lot of traders will wait to buy. Bulls probably bought the 6 low. You can see it fell 4 ticks below the 6 low. That means that there were probably a lot of bulls with limit orders to buy 4 ticks below the 6 low. Traders know that probably at least half of the days over the past few weeks have had early sell-offs that reversed up and formed a low of the day. Yesterday is an example. Today the bulls are trying to get it again. Another example, sell off for an hour, hour and a half, low of the day. Well, here sell off for 6 bars, and it was the low for a few hours. Sell off, low of the day, but not strongly bullish, right? And today's probably, if the bulls do succeed, it's probably not going to be a strong bull trend day. Sell off, reversal up, not strong bull trend. Sell off, reversal up, not strong bull trend. Sell off, reversal up. It became a trading range. Most reversals lead to trading ranges, not opposite trends. All right, so for the bulls to buy above 12, I think the bulls want the bar to be perfect, closing on its high, maybe a 1-tick tail. We're still always in short, so the probability still is sellers above and that we go lower, but it's a reasonable swing buy for a possible low of the day. If you want higher probability, you wait to see if we start to get 2 or 3 consecutive bull bars. If there's a 2-tick tail on the top of 12, even fewer bulls will take the buy. 11 is a surprisingly big bear bar, and whenever you have any kind of a surprise, the odds are you're going to get at least a little follow through. Right? You see how in the final seconds they put a 2-tick tail on the top of 12, right? That lowers the probability that this is the low of the day. It increases the chances that it's not the low of the day, so it increases the chances that there'll be sellers above, and that will go below the 12 low. The computers, put that tail on the top of 12 for a reason, right? They want to weaken the buy signal above 12 and make bulls less willing to buy high. So the bears are hoping that traders will see this as a weak reversal up, and there'll be fewer buyers, and therefore the bears who put that tail on the high of 12 have a better chance that we're going to go lower. Sometimes you get a sell-off that keeps getting decent reversals, and it makes traders hesitant to sell at the high of the prior bar, the 6 high, the 12 high, and it just keeps channeling down. And this has the look of that kind of a sell-off. Kind of like this, it just keeps reversing, never all that strongly, but strongly enough to make the bears hesitant to sell above bars. Same as this, keeps trying to reverse, bull bar, reversal bar, and the bears don't want to sell above because it looks like it's trying to reverse, yet it keeps going lower. And so today might be similar to this. When that happens, usually the best choice is to wait until we get clarity. On that day, we got a bull bar closing on its high, and then after 4 or 5 bull bars, we're probably always in long and going higher. So it's higher probability. This day actually was an okay buy above this bar, a wedge with 4 pushes down, 1, 2, 3, 4, and a decent buy signal bar. But higher probability, wait to see if we get 3 or 4 bull bars, and then just buy, stop down here, and hold. If you just look at the 3 lows, 2, 6, 12, you can call it a wedge, but 9 went above 3, and therefore it's actually an expanding triangle. It does not matter whether you call it an expanding triangle or a wedge. The market tried to break to the downside 3 times, and it looks like it's failing 3 times. So it's the same forces, whether you call it a wedge bottom or an expanding triangle bottom. Still always in short, so still more likely sellers above 12 than buyers. But if the bulls get 3 or 4 consecutive bull bars, even without getting above the sell climax high, the 11 high, it could still become always in long. Four bars without a bear body, still not enough strength to convince traders that the bulls are in control. For the bears, it's around a 50% pullback of the prior leg down. So the bears are selling here for any reason at the market, below bars, above bars, 50% pullback, betting that we're in a bear channel. And the problem that both bulls and bears have is the math. If a bear sells here, his goal is a new low, and his stop is up here. Okay, so he's selling here, reward is equal to his risk, and probability is at 60%. That's what he needs if he's planning on exiting at the 12 low, and it is not a 60% probability. And for the bulls, they're buying here looking for a swing up. They expected to get above the sell climax high and back up to the high of the day. Their stop is below 12. Their reward is up here, greater than their risk, but their probability might be about 50-50. So it's not very good math for the bulls either. Trying to become always in long. What happens at the 9 high? Are there more buyers or sellers? You can argue that we're breakout mode. We're in an expanding triangle, and theoretically, therefore, traders will buy on a stop above 9, looking for a measured move up. But with all of the reversals, more likely sellers above 9, so better to buy a pullback than to buy the breakout. Potential gap, 16 close, 14 high. Bulls want to keep the gap open. If it closes by 2 ticks or more, in other words, if we fall 2 ticks below the 14 high, it reduces the chances that this is the start of a swing up. For the bulls, tail on the top of 12, bad buy signal bar. Entry bar 13, okay, but not especially big. Bad follow through 14. Bull bar 16, again, not particularly big. And so far, bad follow through 17. So even though the bulls are trying to make it always in long, it's not yet clearly always in long. And even if it does get clear, it still looks like a bull leg in a trading range day. Like yesterday, similar to yesterday, up for a few bars, pull back, and then a couple more bars, small bars, bad follow through, and the market stayed sideways. Bears, they'll sell here, stop above 9, betting that we'll pull back at least far enough for a scalp. I did not do that. Right now I'm flat. If we get a decent close on 17, then we're probably always in long. So at least a 1 or 2 tick bull body, even without going above the 9 high. But again, always in long does not mean bull trend. It just means that if we reverse down, there probably will be buyers below and we'll probably go back up. Because of all the trading range price action, I think we'll test the 14 high within the next couple of bars. The bulls will try to keep the gap open, and the bears will obviously try to close it. Will there be a lot of bears buying back shorts above 9? I don't think so. They had a lot of time to buy back their shorts on the way up. So I don't think there'll be a lot of short covering above 9. So we're probably always in long. But because of the trading range price action, anyone who's buying for any reason needs to stop way down here. Where are the bears panicking out of their shorts? They're not panicking, right? They had plenty of time to get out. And in fact, bears will sell expecting a pullback. And for the bulls, they're not worried about buying up here because they're confident if we get a reversal down, it'll be like yesterday, maybe fall for 5 or more bars, but then get back up to this high. So if they buy that close or this high, even if we sell off down here, at the moment, probably a 60 or 70% chance we'll get back up here again in an hour or so. So the bulls are not panicking out of their longs by this reversal. I think we're always in long, but this looks a lot like this, a weak rally, and therefore probably we'll pull back. Here we pull back for 5 or 10 bars, 5 or 10 bars. Probably will test the 14 high, but probably buyers below bars, buyers below 18, buyers at the 14 high. Something I sometimes do in a situation like this, we have a bad tail on the top of the buy signal bar, is put up a 1 minute chart, and I just didn't do that today. And if I see 2, 3, 4, 5 1 minute bars closing on their highs, I view that as pretty good buying pressure on the reversal, and I'll buy at the market after I see here 3 consecutive bull bars. I did not do that today. I should have. Whenever I see a questionable, good context, wedge or expanding triangle, but a big tail on top of the bar. Expanding triangle bottom, 2, 6, 12. Now expanding triangle top, 3, 9, and 18. But strong enough reversal up. Probably any reversal will be minor and become a pullback. So low probability sell below 18. Oh, I was in short for that double top with 9. Again, it's similar to last week, Thursday. Right here. 2 legs down to the moving average, 2 legs down to the moving average. Here we got a third reversal, and we ended up getting a double top that led to a huge bear trend day. Not likely to happen, but if we start getting, if this bar suddenly gets really big like that, we're probably back to always in short. It's really interesting how it's, reasonably similar. 2 legs down to the moving average, double top. 2, we got a third leg down. You can call it 2 legs down here and a double top. Are we still always in long? Yeah, remember I said I thought we would fall back below the 14 high for the limit order bears to make money. So the minimum objective has been reached. We had a buy climax, we went below the bottom. We have a sell climax, went above the top. We have a buy climax, went below the bottom. We have a sell climax. I don't know if we'll get back above the top. But this is an interesting situation. We have a double top, lower high, neckline 12, probably buyers around where we are, the 12 high. But 20 is a little bit of a surprise, and that makes limit order traders hesitant to buy, especially since it fell more than a tick below the 14 high. So the bulls hoping for a measured move up. Now, instead of a bull trend, are hoping for a trading range. 60-minute moving average support, testing it again. I did not yet buy. $20 is enough of a reversal to make me hesitate. And sometimes you get these deep pullbacks and multiple reversals, and I think it's pretty difficult to trade. Like this, abrupt reversal down, abrupt reversal up. Same thing. Bull breakout, deep pullback, reversal. Like this. Today, while it's not as bad as this, it's starting to look like it. Our trading range where the market falls strongly and then reverses up strongly, then reverses down, then reverses up. I said traders would not buy the breakout above 9 and that bears would sell for a scalp, but it looks like the bears held for more than a scalp, at least part of their positions. And similarly down here, the bears do not want to be selling too low. But a lot of the bulls are hesitant to buy because 20 is as big as it is. What do you do to buy? In a situation like this, I usually wait to see if it goes sideways for a few bars and create some micro double bottom. And for the bears, we're always in short, maybe. I think it's not yet clear. I don't want to be selling low. Selling low was bad here, and here. Buying high was bad here and here. It's a trading range day, so you want to buy low, not sell low, and we're low, so this is the buy zone. The bears are trying to convert it into a bear trend, just like the bulls tried to convert it into a bull trend here. 60-minute chart, still head and shoulders top. So left shoulder, head, right shoulder, lower high, major trend reversal. Bull trend, bear breakout, lower high. Four consecutive bear bars closing near their lows. The bulls do not want to buy, even though we're at support, low of the day and 60-minute moving average. We're more than 18 bars into the day. If we break below 12, 90% chance one will remain the high of the day. So if we break below 12 and reverse up, 90% chance we will not get above the one high. That does not mean 90% chance of a bear trend. It just means that 90% chance the one high will remain the high of the day. After 18 bars, if you break to a new high, then you've probably seen the low of the day, 90%. If you break to a new low, then you've probably seen the high of the day, 90%. Everybody knows that general concept that after the first hour or two, 90% chance you've seen either the high or low of the day, and therefore the bulls will try hard to prevent the market from falling below the 12 low, which would be a new low in the first 18 bars, because then they only have a 10% chance of getting all the way up to the high. So they don't want that to happen. They don't want that marker. They don't want everyone to conclude that it's a sell rallies day. So they're buying here above the 12 low, trying to prevent it from getting below 12, just like bar 18, the bears sold, trying to prevent it from getting above the high of the day, because if it got above the high, then we're probably not going back to the low. And if you're a bear, you want it to go low. I was out looking at other charts. I really should have sold that 18 low. on the theory that the market will try to break above the high of the first 18 bars or break below the low of the first 18 bars. If around bar 18, 19, or 20, you get, or 16, 17, 18, sometime around bar 18, you're getting a reversal, it's a reasonable swing short. If 18 was down here, it's a reasonable swing buy. Like yesterday, bar 18, you get a reversal up around bar 18. It's a reasonable buy, taking a chance that this will be the low of the day. Now, can you sell on a stop one tick below 12? Well, if it gets below 12, you know that the market is probably not going to go above 18 or above 1, certainly above 1, probably not above 18. And therefore, if you sell on a stop below 12, you trade small, put a stop either above 1 or above 18, and you look to sell more higher, and you probably will be able to avoid a loss. Sometimes you get a trick day. We had it here. Here's bar 18. It broke to a new 18 bar low and immediately reversed up strongly. So it became a failed breakout, and we rallied for the rest of the day. You can see the bulls trying to prevent it from getting below the bar 12 low. For the bulls, double bottom 12.23, but 5 consecutive bear bars all closing below their midpoints. I would wait for a second entry buy. So I'm not eager to buy above 23. Buy a second entry buy, like some kind of a micro double bottom. Here we had a micro double bottom, up, down, up. Here we only had a first entry sell, but at least the bears had an II pattern. Here we had a second, third entry sell. Here we had a first, second, third entry buy. What about the argument that we only had a first entry buy here and a first entry sell here? Well, we also had a double bottom, and here we also had a double top. Here you can argue it's a double bottom as well, but I'm going to wait for at least a micro double bottom. Right now, I think we're always in short, and therefore I think there are sellers above 23 and sellers below 23 and sellers below 12. But you can only take a short if you're willing to put a stop above 18. The alternative is to wait for the breakout and see if it's big, and then sell after you see the big breakout, like this. And for the bulls, I'm going to wait to see if we get a micro double bottom before thinking about buying. Swing bears from the 12 high are still short. Their stop is above 12. Swing bulls above 12. I don't know. I probably would have gotten out below 18. So a lot of the swing bulls, I think, are already out. So this is interesting, the 12 low. What's going to happen? Will we break out and begin a trend day down, or will we reverse and continue the trading range day? The bulls want this. Break below the first 18 bars and then big reversal up. Break below the low of the first 18 bars and trying to get a reversal up. That is a micro double bottom. Down on 22, up on 23, down on 24, up on 24. So it's a micro double bottom, but I still think we're always in short, even if we go above 23 or 24. So I'm gonna wait. If we get a low 2 short here over the next 4 or 5 bars, that would be another swing sell. Low 2, bear trend. This would be more like today. Double top, double bottom, and then a low 2. And then when it triggered, we got a measured move down. So this is what we might get today. Trying to reverse up. And if we get a low 1, low 2, especially with the bear bar closing on its low, even though you're selling at the bottom of a trading range, it's a reasonable swing short for a trending trading range day down. It'll take a few bars for that to develop, if it's going to develop. Low 2, the bottom of a bear trend. Bear's got more down. This is interesting here. Double top, double bottom, and a low 2. But do you see what's different here? It's the bottom of a trading range, but it's also a rally, trading range, trend resumption, or trend reversal. So this is, what came before it to the left is more bullish than to the left here. We got a rally, but it's still below the moving average, and the rally is not all that strong. Rally here, much stronger rally, and this looks more like a bull flag. 2 legs down, 1 pullback, 2. Even though the low 2 triggered, I don't know if you can see, low 1, low 2, it triggered, but immediately reversed up. Low 1, low 2, immediately reversed up, because the market saw this entire sell-off as a pullback from a stronger bull trend. So either, I think we're going to try to get the low 2, and then will it trigger and reverse up? Or will it trigger and have a decent entry bar and then lead to a trending trading range day, upper range, bear breakout for a few bars, and then a lower range? If 26 gets a couple of ticks bigger than it is, it'll reduce the chances of the bears getting a low 2. If the reversal up is too big, usually you do not get a low 2. Okay, tried to reverse up, did not get above the moving average, so not a very big reversal up. The bears had a reasonable chance at a low 2. reversal up, two legs up, 1, 2, neither one very big, stayed below the moving average. The bears had a decent chance at a low 2. If this bar gets even a tick bigger, it'll significantly reduce the chances that the bears can get a low 2 over the next several bars. Low 2 bears selling around the moving average, trying to prevent the bar from getting too big. Now, do we have a 90% chance that we're not getting above the 18 high? I don't know. We immediately reversed up. In general, by the close of 18, you have a 90% chance of having seen the high or low of the day. And, after the close of 18, we went to a new low. That means 90% chance one will remain the high of the day. So right now, I think, I don't know if it's 90%, every tick that we go up lowers that 90%, but it's still far above 60% right now. So maybe it's 80% chance that we've seen the high of the day, which means chances are there'll be sellers, the bears will sell this rally in the sell zone, but so far, decent bull bar, making bears hesitant to sell. We're around a 50% pullback, and we're at the moving average. It's already high enough up to make a lot of the bears hesitant to sell. They wanted 26 to stay below the moving average. Stop order bulls above 24 made money, so that is bad for the bear argument. If you're in a bear trend, you do not want stop order bulls. You don't want bulls making money with stops. I think we're still always in short, but this is not doing what the bears wanted to do, so bears are not shorting it yet. This is becoming one of those it's becoming one of these days where you get big abrupt reversals and you stay sideways all day. When you have expanding triangles, you often get additional legs. We have an expanding triangle, 2, 6, and 12. So you get an expanding triangle bottom, usually converts into an expanding triangle top. And now we have another expanding triangle bottom. And eventually, usually before long, it stops being an expanding triangle and forms something else. It either goes sideways or breaks very far above the top or very far below the bottom. But we're still having expanding triangle behavior. Low, new low, lower low, lower low, and then high, and then higher high. Part of the reason for this rally is the buy the close bulls 17 never really got their second leg up, and a lot of them buy more after a pullback above a bull bar 23, and so they buy the 17 close, and then they buy more above a bull bar here, and this is their average entry price. And some of them are exiting right here. Others are holding, hoping it gets back to the 17 close, where they could get out, break even on their first buy, and then with a profit on their second buy above 23. Can you sell at the market? Well, I think you can buy or sell, right? I would not buy, but if you're selling, your stop is above 18, and this is a strong enough reversal to make me think there are buyers below 27, and therefore it's still probably early to sell. Can you buy above 18? Well, it's an expanding triangle. Traders who sold below 2, below 6, below 12 lost. Bulls who bought above 3 and above 10 lost. Traders are selling, they're fading every breakout. So you can argue that eventually it has to become a trend, and that is true, but you can lose a lot of money betting on a successful breakout on a day that is reversing after every breakout. For me to sell below 24, I need a strong breakout and sell a lot lower. For me to buy above 18, I need to see a strong breakout above 18 and then buy higher. We're probably going to get a lower high here, but 3 consecutive bull bars, a lot of bears will wait for at least a micro double top, just like a lot of the bulls waited for a micro double bottom here. The reason why we're going up, I think, is the 17 by the close rally, and then 18 broke above 9, and therefore it was reasonable to buy either the 17 close or the 19 or the 18 breakout above 9, and therefore those bulls will not sell out even below 12, and they'll buy more above a bull bar 23 and hold for a test of that 17 close. And it looks like that's where this is going. Getting up to the sell zone, the market reversed down on 1, on 4, on 10, on 18, and we're getting close to the 17 close, where I think the scale end bulls who bought that close will look to exit. So we'll probably get a pullback somewhere around the 17 close. We're fairly close to it right now. If you're a computer, you can buy this right here, but individual trader, I think it's too high to buy, and the channel up is too tight to sell. Could you sell and put a stop above 18 or above 1? I still think the odds are we've seen the high of the day, and so theoretically you could put a stop above 1, but this is up too strongly, I think, for most traders to sell yet. Tough to do anything right here. The channel up is too tight, too many bars up to sell, even though we're in the sell zone. And for the bulls, unless we break strongly above 18, the only bulls buying are the scale end bulls trying to get it back to the 17 close, and those bulls will look to sell around the 17 close. And we're within a point of that, so this is not a good buy zone. You can see it went 1 tick above the 17 close, and bulls sold. The 17 by the close bulls who held despite the new low below 12 are getting out break even. They're happy to avoid a loss on their buy of the 17 close. A lot of them bought more above a bull bar 23. Will we break to a new high? I don't know. For me to buy high, I need a strong breakout, and today has been a reversal day. Reverse down. Probably will reverse down from around where we are, and reversed up. Trying to become a trend day. Looks like we'll go above 18. I think we're always in long. but because of all the reversals, traders are hesitant to buy high. It did not work here, did not work here, and they're hesitant to sell low. Bad here, bad here, bad here. So traders need more information. If we pull back to the moving average, they'll probably buy. If we break out extremely strongly, they'll probably buy, but I think they'd rather buy a pullback. And for the bears, they need the market to go sideways for at least a micro double top. This is one of those interesting trades where you just sell right at the market or with a limit order, one tick below the 18 high, and a stop one or two ticks above, knowing that you'll probably lose money, but that your risk is only 3 or 4 ticks, and you're looking for a move back down to the low of the day. So you're risking 1 point to make 4 points. Unfortunately, the probability that you'll be profitable might only be about 25% or so. So, that is not enough reward relative to the risk to take the trade. Also, traders taking that kind of a low probability trade have to be willing to lose 75% of the time, 80% of the time, and that's a lot, and it's not fun. So if you're a machine, you can do it, but if you're a person, you don't want to be losing 70 or 80% of the time. Trading has got to be fun. Also, if you lose 70% of the time, the 30% when you win, you have to trade them perfectly because you have to get as much profit as possible out of the few winners to overcome all the losers. Apple reports earnings today. Head and shoulders top, left shoulder, head, right shoulder, but very strong reversal up, big down, big confusion, going sideways here in the middle of a trading range that has gone on for several months. Just looking at the chart, it's pretty neutral. And traders always look at the money straddle going into earnings. The nearest expiring options are Friday's options, so 3 days left. And we're right around 149. So traders will look at, let me just pull it up, the price of the options expiring on Friday that are nearest to the money. Okay, so the 149 call right now, let me just pop it up. Okay, the 149 call right now is around 270, and the 149 put is around 277, let's say 280. So if you add the two together, you get like $5.50 or so, $5.50. And you divide that by the current price, let's say 150, and that gives you an idea of the percentage move traders expect after earnings come out after the close. So they're expecting about a $5 move up or a $5 move down after earnings come out. And the options are priced in a way so that it's really difficult to make money. There are all kinds of tricks you can do. You can say, okay, 50% chance we're going up $5, 50% chance we're going down $5. Maybe I'll buy both the put and a call. Well, if you buy the put and the call, it costs total $5. So, even though you could be right that it could go up $5 or down $5, so you can make $5 or lose, up or make $5 down, it's going to cost you $5 if you take both bets. And you can do spreads, and the option sellers make the prices of everything so that they always have a slight advantage. So, I usually do not trade options right before earnings, like the day of earnings. Sometimes I do, if there's some technical pattern where it looks like the market is probably going to go up or down. Sometimes I'll trade an at the money call or an at the money put. But with Apple right here, I think it's not worth trading. I don't see how I can structure a trade. If I just buy the call, I pay whatever, $2.70, or if I buy the puts, I pay $2.80, but chances are, only 50% chance it's going to go far enough to make it to just break even. So, in a situation like this, I would do nothing. And on television, the guys who bought the calls tonight on Fast Money will say, "Oh yeah, of course it was going up." If it goes up, if instead goes down, they'll say, "Oh yeah, it was obvious that you should have bought puts." And it's not obvious; it's just totally neutral, and really hard to make money buying puts or calls going into earnings after the close today when the market is as neutral as it is. I talked about selling right here, betting on the double top. Can you buy right here, betting on a break above the double top and a measured move up? Well, I would not do that either because of all the reversals. I would wait to see if we start to break strongly to the upside and then buy higher. Right now, I am flat. We're in the sell zone, but if we do reverse down, we'll probably get buyers around the moving average. So I'd rather be buying around the moving average. I compared this to a couple days ago where the market broke out of the 18-bar range and then rallied. But look what happened with the rally. Here's the 18-bar range. It broke below and reversed up. And after the rally, this is what it did. Similar circumstance, reversed up from a new 18-bar low, reversed up from a new 18-bar low, reversed up pretty strongly, rallied, and then just went dead. Bulls trying to get their breakout right now. What happens if we get to the new high of the day? Here, same kind of thing, new 18-bar low, new 18-bar high, very strong rally, and basically a type of expanding triangles, new low, new high, new low, new high, and not really very far up or down. Again, new low, new high, new low, new high, but never really went far above the range. So always in long, but I think not very bullish. It's a trading range day where the market repeatedly reverses. Traders would rather buy a pullback to around the moving average than a breakout. 60-minute chart. Does that look like a great buy? Fairly tight range, big bear bar, and the market is trying to get traders to buy above a big doji at the top of a 10-bar tight trading range. That does not look like a very good buy. limit order bears 18 high. They need it to fall 5 ticks to make a profit, and therefore there is support 4 ticks down below the 18 high. You got bears with limit orders trying to buy 4 ticks below the 18 high, so there's support right here. I do not know if they'll make money. I'd rather buy a pullback around 4 ticks below the 18 high, which would be around the moving average. Whenever we get a rally, I'm always looking at gaps. We have a gap here. We're already beyond that measured move. We have a gap here, this low, that high, already beyond that measured move. And then we have a gap here, not quite to that measured move. And then we have a gap here and a lot of room up to that measured move. So the next measured move target is the high of the day based upon this gap. I think we're going to pull back to around the moving average and around 4 ticks below the 18 high. I'm not sure that we'll pull back 5 ticks below the 18 high. So if you're selling, it's probably better to sell 1 tick above the 18 high instead of at the 18 high, thinking that there'll be a lot of buy limit orders 4 ticks below the 18 high. Better, I think, to be buying around 4 ticks below that high, so somewhere around here. What are the chances that we get all the way back to the 24, below the 24 low? I think it's small. I think 90% chance we've seen the low of the day. It's no longer 90% chance that we've seen the high of the day. It's probably like 50-50. The reversal up is an 11 bar bull micro channel, no bear bars. The odds are we're not going back to the low of the day. And the odds are there'll be buyers around the 34 low and 1 point lower and 4 ticks below the 18 high and and around the moving average. But the odds are also that we're probably going to start to go sideways in a pretty tight range. Final bar of the third hour. We went down, we went up and down. We're going up, top of a tight trading range. Probably a couple legs sideways to down to the moving average. Unlikely to get another big reversal all the way down. Here we had 1, 2, 3, 4, 5 or 6 reversals, which is a lot. Here, 1, 2, 3, 4, 5, and maybe 6. Probably sideways here. If 37 closes near its low, below its midpoint, that would increase the chances that we're going to go sideways for several more bars, which I think is going to happen. Bulls got a close above the midpoint, but I think it's a small version of big up, big down, big confusion. And a lot of the bulls will wait for a few bars to see if we get a double bottom at the moving average and then buy. We're still always in long, and the limit order bears 18 are trying to make their money. They need it to get one more tick down. I suspect they'll do it, but it might take a few bars to get there. High 137, always in long, but 3 consecutive bear bars. I think the odds are we'll go sideways more. I think it's okay to be long, to buy the 34 low, to buy 3 or 4 ticks below 18, to buy the moving average, to buy 2 legs down, to buy a high 2. I think the downside risk is small. Probably this is the best the bears get. 50% pullback. As for selling, I think if you're selling, you had to sell at the 18 high or above the 18 high. I would not sell the 37 high, and I would not sell with a stop below 34, 35, 38. Bulls trying to get a high 2 at the moving average. You call it a triangle. We went down and up on 32, and then second push and third push. I still don't think we're going to go a lot higher. We may go a little bit higher. Might come down and test this gap. You can see on this day there was a deeper pullback. I think we're probably going to pull back lower. You have the limit order bears. It keeps hitting their limit order. I think they'll probably make money, and I think we'll probably trade down a little bit lower. But I also think we're always in long, and I also think, we've seen the low of the day. I think it'd be, maybe 20% chance we get back below the 24 low, so 80% chance we will not get below the 84 low, and 50-50 chance we'll get to a new high. The limit order bears 18 high will give up, right? They might give up right here. We have a high 2 with 37, and that might be enough to make them give up. If 41 had a bull body, I think that would increase the chances that they'll give up. But you certainly do not want to be short when the market's always in long. If the market is rallying from a high 2 bull flag above the moving average, the bears are hoping for a surprise reversal down, for a quick measured move down here. I don't know if they get it, but I think the odds are we're going to stay always in long at least for another hour or so, even if the bears do get the breakout. The reason why I'm bringing up the breakout and reversal is, we've been reversing all day, up and down and up and down and up and down and up and possibly down again. However, this last reversal is strong enough and the context is good enough to make it likely to remain the low of the day. Wedge lower high, 3 pushes up, 1, 2, 3, but probably not going to go much down. There'll be buyers below 41 if we get there, even if we fall all the way down to the 60-minute moving average. I tried to buy 4 ticks below the 18 high and did not get filled, and I've since pulled my order. I'll wait to see if we get a second leg down, maybe to around here. This is one of those cup and handle type higher lows where you got a reversal and then a pullback. Odds are we go higher. We might go lower first, but the odds are we're going higher. A lot of times between 9:30 and 11:30, the market just drifts around and it looks like it's going to do something, but the probability is less than what you think. So the bulls have a high 2 buy here at the moving average, and it only became a 5-tick failure. We're still always in long. Even if the bears get a breakout below the double top, the odds are we'll get buyers below. Maybe if it does fall for a measured move target, I think there'll be buyers below 42, buyers around the 60-minute moving average. And I still think odds are high that we've seen the low of the day. What does high mean? Right now, maybe 70%. Cup and handle patterns like this, cup and handle, a reversal, and then a bull flag, are okay patterns. Depends on context. Here we're still in a trading range, so it's not as good. So the cup is the reversal up, and the handle is the pullback, the bull flag. And sometimes you get a bull trend, sometimes it just doesn't work, and you get a deep pullback. So the cup is the reversal up. And then the handle is the bull flag as it starts to reverse up. For the bears, I think it's hard to sell. Traders tried to sell the 18 high and got a 4-tick trap. It had to fall 5 ticks. And I just noticed they made money selling the 43 high. It fell 5 ticks. But difficult to make money. Range very tight, 7-tick range, difficult for the bulls. They're trying to buy below bars and they're unable. The bulls are about the 34 low. Here we are 15 bars later, 14 bars later, and they still have not made 1 point, even though they bought with a limit order and a bull trend. Now, we have a double bottom, 40 and 50, still always in long, but you have the problem of the tight trading range. So anyone buying for any reason, the bear closed 49 above 50, stop is still down here. And I would not sell. If we do this, I'll think about selling, but I probably will wait. The odds are we're not going to get below this, even if we do fall for a measured move down from the double top. That's the bigger high 2 buy with a good bull bar. But because of the tight trading range and because of all the reversals today, you can only take the buy if you're using a wide stop below 24. You're not going to let the stop get hit, but it does give you time to make decisions if we do trigger the double top and fall below the 41 neckline. I don't know if any of you heard of Jim Rogers. He used to pop up on Wall Street Week with Louis Rukeyser 10 or 15 years ago. I don't know if he's a billionaire, but he has a lot of money. And I think he likes being on television. He likes giving interviews and he likes saying some outrageous things. I just read an interview with him from a month or two ago in which he's saying that we're going to have a crash, the biggest crash in his lifetime. He's about 10 years older than I am, so that would include the 87 crash and the 2007, 2008 crash. Obviously, we are going to have a crash. Every 10, 20, 30, 40, 50 years we have crashes. The market always has them, and we'll have another one. And, what is a crash? In 87, it was losing 26% in a day. Sometimes it's losing 50% over the course of a year or two. In 1927, it was losing 90% over the course of a few years. I agree with him that we're going to have a crash, but I just read his interview and he makes it sound like we're going to have a crash near term. Near term, he won't specify, but he's saying that the market is so overbought that it's going to result in a crash. And who knows, right? I don't think there's a lot of risk. Here's the cash index monthly chart. We still might test back down to this double top. This may not have been enough of a test. I do think we're going down to the 1800 area at some point in the next several years. This is up so steeply that we'll probably have to go sideways for a year or more before we can create a credible top. If it gets down to this double top, is it a crash? That would be losing about 30%, 35%. I think it depends on the rate at which it falls. Here, back in 2007, 2008, we fell from 1600 to 800, so we lost about 50%. We lost about 40% here. Were those crashes? I don't know. I wouldn't call them crashes. 87, I would call it crash, even though it looks tiny compared to these. It was 26% in the day, and to me that was a crash. But if it gets down to 1800, which I think it will within a few years, I don't know if I would call it a crash. That would be whatever, 20% correction. That's not a big deal. When you look back, here's a 50% correction, here's a 40% correction. If we have a 20% correction, who really cares? It's not a big deal. I want to say one other thing about Jimmy Rogers. He's a rich man. And he was not born rich, at least I don't think he was born rich. He made his money. However, how did he make his money? He made his money because he was partners with George Soros. And George Soros is 10 times richer than Jimmy Rogers. How can that be? They were partners. How can George Soros be 10 times richer than Jimmy Rogers? My belief, without any evidence, is that George Soros is a very smart man and a very good trader. And he made a ton of money for himself and Jimmy Rogers. They split, they went their separate ways. Jimmy Rogers, apparently, I'm not aware that he made much money after leaving Soros. Soros continued to make a fortune after splitting with Jimmy Rogers. So it makes me believe that Jimmy Rogers made money because he happened to partner up with George Soros, who was an exceptional trader. I'm not at all. I don't see any evidence that Jimmy Rogers is a trader, and that Jimmy Rogers has any great understanding of the market. I think George Soros has a tremendous understanding of markets, and that's why he has continued to greatly increase his wealth after splitting with Jimmy Rogers. My point is that even though Jimmy Rogers is on television all the time, and the interviewers always talk about him with a lot of reverence, that he has hundreds of millions of dollars, maybe $1 billion, the implication is that he earned it. I'm not aware that he did. I suspect that Soros earned it, and Rogers was lucky to have Soros as a partner, and therefore I don't believe anything that Jimmy Rogers says. So, just because he's rich and he made a lot of money does not mean he made the money because of his own efforts. I think he just happened to be lucky to partner up with an exceptionally smart trader, George Soros, and he made his money, riding on Soros's coattails. I could be completely wrong, but that, from what I see, that's what it appears to be the case. And because of that, whenever I see Jimmy Rogers give an interview, or whenever I read an interview with him, I don't believe anything that he says. I happen to agree that we are going to have a big correction, but I think it might take 2 or 3 years to happen. I think we'll get down to the 1800 level, maybe a little bit below, who knows. But I do think we'll get down there at some point over the next several years. Not much risk of it over the next many months because the channel up is so tight. As for predicting a crash, you can predict a crash, and you will be right. And the issue is when, right? And just because the market crashes regularly, every 30, 40 years it crashes, and it's done that throughout history. And every time it crashes, the government institutes policies so that it will never crash again. Yet the policies cannot foresee every variable, and the result is it continues to crash. It keeps crashing. So after 87, it was never going to crash again, and then it crashed in 2007. And 2007, it's never going to crash again. Well, guess what? It's going to crash again. And I don't know what will be the thing that gets it going, but there will be big corrections. Small correction, 5% happens, every couple of years, 10% every few years, 20% every 5 or 10 years, and 30 to 50% every 20 years. And I see no evidence to indicate that the pattern will change, and therefore we will continue to get 30, 40, 50% corrections forever. And nobody knows that they're coming, because obviously if people knew, they would not keep buying and then get trapped into buying high when the market quickly falls 20, 30, 40, 50%, right? So they always happen for unanticipated reasons. In 1929, the market crashed, and there was no reason. Lots of people have done all kinds of research on the 1929 crash, but from what I see, it just crashed. There was no logical precipitating event. The market just started selling off, and then it started to accelerate down, and it went down relentlessly for several years. And therefore, saying that it has to be some computer algorithm thing, or some thing that we cannot understand, some black box thing with all the computers operating, like in 2007. I don't care. It's going to crash, and people will come up with a reason, and who knows what the reason is, other than there's nothing people can do to prevent crashes. They are going to happen, and they're always going to happen. So when Jimmy Rogers says the market's going to crash, he is right. But if he says it's going to crash next year or the year after, I think that is a low probability bet. Predicting any reversal is always a problem. Eventually you're right, but if it takes a long time to be right, then you're wrong. And that's true. I thought the market was going to top out long before this. I thought it would top out before 2,500, but it keeps going up to 2,500. Will it correct? Sure, but if you cannot predict the time and the price, everybody can predict the price. Everybody knows the market's going to correct. Maybe test this area. I think it's going to test. This is the monthly chart. I think it's going to test this area within a few years. But timing it is really difficult, because trends can last a long time. And this is a very tight bull channel in the monthly chart with no sign of a top. I just wanted to make the point that I don't know if you saw the interview with Jimmy Rogers, and my point is that just because he made a fortune running a trading company does not mean he did the trading. His partner, George Soros, I believe, did all the trading and made all the trading decisions. And Jimmy Rogers just got lucky picking someone who turned out to be one of the best traders in the past 30 or 40 years. Very tight range, 9-tick range now for 25 bars, 2 hours. You can see on the 60-minute chart, 2 small sideways bars. And 50-50 chance we'll get trend resumption up, 50-50 chance we'll get trend reversal down. I think it's important that we fell below the low of the first 18 bars, and here we are 3 hours later, and we have not gone to a new high. And that shows the importance of a breakout of that opening range, the first 18 bars of the day. Very often you'll get reversals, but they don't quite make it all the way up to a new high. And it's because traders know that once you get a breakout of the first hour and a half, it usually does not break out of the other side. So bulls take profits just below the other side, and bears sell just below the other side. Breakout below the 18 bars. Here, it broke below the 18 bars, reversed up, and in the final hour, it got back to a new high. Here's the bar, 18th bar, and we broke below the 18 bar range. This did not break above the 18 bar range, but we did get above the 18 bar range at the end of the day. Let me fix this to make this clearer. Broke below the 18 bar range. Here's the 18 bar range. Reversed up, but never got back above the top. This is the other day, double top, broke below the 18 bar range, reversed up, did not get anywhere near the top. Here, we broke below the low of the first 18 bars here, and we reversed up, never quite got all the way back to the top. Similar to today, even though it rallied for 4 hours, it could not get above the top of the 18 bar range. Here, we did get above the top of the 18 bar range. In the final hour. Today is kind of like this, a reversal and then a tight trailing range. The bears get a double top lower high, and the bulls get near the top of the 18 bar range, and in the final hour get a little bit of breakout. This is, I think, similar to today. This is last week. Incredibly quiet market. Here, not even 1,000 contracts. About 800 contracts on that bar. Here, a couple thousand contracts. A couple thousand. Here, 1,000 contracts. And, not even 1,000 contracts. A one tick tall bar. When the market gets this quiet, I should just wait. You can argue we're on a 20 gap bar buy above 50. You can argue that we have a double top pullback with a bear bar 58 bear close. So it's on a sell, it's on a buy. I think it's just better to wait. I suspect it's waiting for Apple's earnings. Apple is it's the biggest corporation in the world, and therefore it's important. And then after Apple's earnings, it'll wait for the Friday unemployment report. And then after that, there are all kinds of little things along the way. And it's probably waiting for all of those central bank decisions around the world in September. 62 and 58 closing on their lows is important because it's a reasonable sell signal for a failed breakout, expanding triangle, whatever you want to call it. And a lot of times you'll get a tight trading range with a bear bar closing on its low, and the market goes below the low and eventually works lower and lower and lower. And it never looks all that bearish when it's happening, but tight trading ranges can lead to big reversals. Here we have a bear bar, we have a double top, we have a fairly tight range. This is a tight range here, and when it falls below that bear bar, it does not look like much, and then it just goes down and down and down and down. So just because things are very quiet and it's a very tight range does not mean that the market has to stay sideways. Here, a tight range, we had a bear bar closing on its low, another one here, and went below both, and it went up a little bit afterwards. But in any case, it's a reasonable sell. You're risking 4 ticks, hoping to make 3 or 4 points, and maybe you have 30% chance of a swing down. Higher probability, you wait for the bear breakout and then sell. So yes, a sell signal bar, a double top, a second entry short, higher probability instead of selling just below that low, wait for a couple of bear bars and then start to sell. Bears trying to get that reversal down from that double top lower high, break out below the triangle. How far down will we go? I don't know. The market's been in a very tight range for 30 bars, so unlikely to go all that far. Probably will not get below the 60-minute moving average. For the bulls, double bottom 50, still always in long, but tight trading range, and that means the probability is not good for doing anything. Double bottom, always in long. Triple bottom, if you count 36, but big bar, so buying at the top of a 7-tick tall tight trading range that has lasted for 30 bars. Not a high probability buy 64, not a high probability sell 62. The odds are we'll just continue sideways forever and ever and ever. And when I see evidence that the premise is wrong, that we're starting to trend, then I will trade again. Otherwise, 7-tick range, I'm going to wait. We had a couple days like this last month, very, very small. Here we got a little sell-off, but it started at 11 o'clock. It's already 12:15, and we have not broken out. This is kind of like today, and we'll probably stay that way for the rest of the day. Same thing here. I am flat. The range is too small. I like to trade, but I like to make money, and sometimes it's just too difficult. So I'm in this to make money, not to trade. 12:35 or so, the market sometimes has a breakout and then a trend up or down. However, when you're sideways like this for 4 hours in a tight range, the likelihood is that we're going to continue sideways for the rest of the day. Bulls, double bottom, 68, but very tight range and getting very late in the day. Will stop entry traders finally make a profit? I'm not sure that the math works out. If you buy above 73, 74, you're risking 7 ticks. How much do you plan on making? Do you plan on making 7 ticks? Do you have a 60% chance of making 7 ticks? The math is not good here. I said a couple of hours ago that we might test the 28 gap, and that's exactly what we're doing now. Gap 27 high and 29 low, but really tight range, and I think the math is not worth it. Very quiet day. Technically, it was interesting early on because of the expanding triangle. Daily chart, now we have 10 bars in the tight trading range. The bulls want the bull breakout, the bears want the bear breakout, and we may go sideways for a month or more like we did in the past tight ranges. We're still in a bull channel, so probably a bear flag. This is probably a spike pullback channel pattern, and it probably will get a break below the bull trend line and then evolve into a trading range and test down to major higher lows like here or here. It took several months to go up. It'll probably take several months to go down. There's no obvious top yet, so it could go further, but I doubt that it's going to go much further because of how overbought the weekly chart is. 37 weeks far above the moving average. That's never happened before in the 17 years of the E-mini. Monthly chart, a 9-bar bull microchannel late in a bull trend, so that is climactic as well. But it's also a sign of strong bulls. When the bears finally get their reversal, it probably will only last a few bars, and the best the bears will get is a minor reversal into a bull flag or a trading range. Yesterday spent most of the day sideways. We had that sell climax early on, and then we had an expanding triangle here, higher highs, lower lows, and then it extended here, and then we had another smaller expanding triangle here, up, more up, down, more down, more down, and then we had another leg to it here, and the bears tried to get a reversal here, but this was just too strong for the bears to get their reversal. You get a reversal up and a pullback, so it's a cup and handle pattern, but like is often the case with cup and handle patterns, the market went sideways instead of up. A couple of interesting things. I talked about the 17 close being a good breakout and therefore probably a buy the close setup, but bar 20 was a big enough bear bar so that we're probably going lower. Still, even though the market went below the 12 low, the bottom of the bull breakout, it still was only a pullback from that breakout. Sometimes you get a pullback below the bottom of the bull trend, and by the time we had 4 bars up, 3 or 4 or 5 bars up, it was clear the odds were we were going to get to the 17 close, but that we probably would go sideways there because the buy the close bulls were so relieved to get out break even that they were more likely to sell out break even on this entry with a profit down here. And if the bulls are selling, the market is probably not going to go higher. The opposite was true here. I'm not sure that the 11 close was sell the close. This was, I think, buy the close. We had 6 bars up, 5 bull bars, 2 closing on their high. But the same is true here for the bears. If they saw this as sell the close, they hold, even though we went above the top of the sell climax, and they sell more below bear bar. when it gets down to the low close, they bought it and it reversed up. I sometimes will take a short like below 18, I should have today, or buy above 12 if it's a reversal on a first leg. But when it's having multiple reversals like this, I prefer second entry buys, or I wait for a breakout and then I just buy a close and scalp. For stop entries today, it's really a limit order day. You know, buying above the bear bar 6, not good. Selling below the bull bar 9, low probability. Buying above 12, you know, maybe we'll get a bounce. You know, tail on top, big bear bar, probably not going up all that far. Buying the or selling the 18 low. That I should have sold that one, because you could argue selling the 11 close was reasonable. Sell the close, and the scale and bears would sell. Plus, you had the expanding triangle top. So that's one that I thought about. But these two bull bars, 16, 17, were strong enough, so it's good enough to get out of a long, but not strong enough for me to sell. And then here, more expanding triangle, and a micro double bottom, but not all that strong. So I waited to buy until it was up in here. And then here, limit order trading. I mentioned that the limit order bears 18 high probably would make money, but look how long it took them to make their money. It took them, 30 bars to make 1 point. And limit order bulls who bought that 34 low never made money. There's still 10 minutes left in the day, and they still might make their money. But I think most of the bulls who bought the 34 low probably get out below the bear bars, 58 or 62. Buy the close, sell the close. Well, bar 2, consecutive bear bars. It's sell the close, but tail on the bottom of 2, bull bar 3, probably not going down all that far. And as far as buying the close, I think this is really not good. Sell the close 11. Buy the close, maybe 16 or 17. We should get up to the 9 close. I'm not sure we'll go much higher. And then on the way down, is it sell the close 20, 21? It's a trading range and it's near the bottom, so we're probably not going a lot lower. And then we started to get smaller bars here with little gaps. I thought it was probably buy the close 28. You can see we got a gap, 29 low, 27 high, and we went up a little bit, and that was it for buy the sell the close. And then limit orders, it's surprising how little good limit order trading there was today. Probably buyers below 2, 3, and 4, probably sellers above 6, and then beyond that it was opposite. Probably buyers below 9, but a lot of the bulls would have been stopped out below 6. Probably sellers above. I'm not sure if sellers above 9. I would not take that sell. And probably buyers below 18, but I'm not buying below a bear bar after a breakout in a trading range day. There's no chance I'm going to be buying that. No chance I'm going to be selling this. If the market is having multiple reversals, I can only look to buy when the market's low, and I can only look to sell when the market's high. So even though we're always in long 17, we have 18 closing on its low. There's no way that I'm going to buy that 18 low. So really not much to say about today, other than it was pretty boring. We have the potential. Everybody knows August, September tend to be volatile months. Sometimes into the first half of October. The two most famous crashes in the 20th century took place in October. 1927 and 1929 and 1987. But most of the time, October is pretty much like any other month. There's one special thing about October. It usually is the start of that bullish window. The most bullish time of the year is the middle of October to the end of April. And sometimes you get a sell-off in October, and traders like to buy it because they know seasonally most of the profits over the past 100 years have come from the middle of October to the end of April. And if a trader went flat, sell in May, go away. If a trader went flat every May, beginning of May, and then bought his positions back in the middle of October, he would have made vastly more money than if he simply held long, the entire time. I'm not advocating to do that, but that is the reality. That seasonally, October through April is very bullish compared to May through the beginning of October. I don't have an opinion here. It's a tight trading range lasting 40 bars, 50 bars. It's breakout mode, and the bulls and bears have reasonable arguments. The bears have a lower high major trend reversal on the 60-minute chart, and the bulls have a bull trend, a trading range, and a bull trend. I think it's balanced. I think it can go either way. I do think we're going to correct down 100, maybe even 200 points before the end of the year, but by the time it's clear that the correction is underway, the correction will be half over. It'll take a lot of selling and follow-through selling for traders to believe that the bears have taken control. And by the time it's clear, the market will be halfway to its target. Okay, how is the new trading course progressing? Any idea when it will be available? Well, most of it is available now. I've created all the PowerPoints over the past, I guess, probably 3 years now, and I've recorded most of the PowerPoints. So you can ask Richard at the brookstradingcourse.com website how to access it. But most of the videos are up there right now, and I do not have many more to record. Well, that's it for questions. This still looks like a bull flag. Whenever you get a trend resumption, trend reversal setup like this, a trend and a trading range, it's slightly more likely that you get trend resumption than it is that you get trend reversal. But once you get 20 or 30 bars into the range, it's basically 50-50. It's very close to 50-50. And that's where we are right now. On daily chart, odds are we'll go a little higher simply because we're in a bull trend. But because of the buy climaxes on the weekly and monthly charts, the odds are against the market going a lot higher. We got the big round number up there, 2,500. I don't know if we get there before we correct, or if we correct and then get up there sometime next year. All right, hope everybody has a good night, and I hope tomorrow is more interesting than this. I like to trade, but I like to make money. And when the range is 7 ticks tall for 2 hours, I usually trade other markets and not the E-mini. Okay, hope everybody has a good night.